Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. Let's get right to it. So question number 1, how to create a paycheck in retirement. Question 2, how to get involved or get started investing later in life. That's from a viewer who is 61. What are the pros and cons of Coast Fire, which I'll explain what that is. Are multi-year guaranteed annuities. You can think of them similar to certificates of deposit. Are they a reasonable alternative to bonds? And then finally, how do I move my IRA away from my financial advisor? That's sort of more of a practical nuts and bolts kind of question that we will cover. If you'd like me to possibly answer your question, you can send it in. The easiest way is just to subscribe to my free weekly newsletter that goes out every Sunday morning. You can do that so with the link below this video, and then just hit reply to any email I send you. I'll eventually read it. I promise that. And that's where I get the questions for the show. So there you go. All right, let's dive in. How do we create a paycheck in retirement? And this is from a viewer named Brett, and he sort of walked through his setup. He's 59. Trying to figure it all out. He goes, well, I've got an emergency fund worth of 3 months, and that's in a high yield savings account. So that's sort of separate, not part of his, a paycheck approach, but just, that he's got that money set aside. And then he has what he calls a bucket for his paycheck, and it's 2 years worth of expenses. It's in a taxable account, and it's in mutual funds, laddered T-bills, and he can pull from that automatically, biweekly. And it goes from the brokerage account that this is in. He doesn't say where, but it doesn't really matter for our purposes. And it gets deposited into his checking account, presumably at his bank. And so that's sort of the paycheck itself. That raises the question, well, how does this get refilled? Because obviously it's going to get spent down, as months go by. So what he does, first of all, he has, of his remaining assets, he has 30% in bond funds, tips, and regular bonds. Here are the funds he happens to use. And then he has the rest of it, 70% in equities. Again, low-cost index funds. You can see some of them here. And what he does is, you read here, he rebalances. Basically, this rebalances back to 70-30 and pulls money out as needed to go into his paycheck bucket. And that's it. That's his setup. Fairly straightforward. And that's his question for me. What do I think of it? I think it's fantastic. In fact, it really is the original bucket strategy that was devised by a financial planner, Harold Avinsky. He has been on the show. I interviewed Harold, and a great guy, and I'll link to that interview below this video, but that's basically what he did. He started it out. He had, in fact, just like Brett, he had 2 years worth of expenses that he pulled out of the portfolio. It gave his clients some comfort to know they had that cash there, and the rest of it, he just invested. So what's happened over time is that folks have said, well, let's get even more creative with the bucket strategy. Instead of having 30% in bonds and 70% in stocks in the investment part of the portfolio, let's think of the bonds in terms of years of expenses as well. So yeah, we got 2 years of cash, fine, but let's not have 30% in bonds. Let's have, 7 years worth of expenses in bonds. What does that really do? Well, it can make rebalancing really problematic if you think about it, because then it's like, well, you're just taking out of stocks every year and topping off the bond bucket. So then they get into the whole strategy of, well, maybe we can reverse the flow and have the buckets flow up back to stocks. Or it's just, I don't know. To me, it creates a bunch of headaches for very little, if any, benefit. So what Brett has done, I'll show it to you again, I think is excellent. Again, the 70-30 split, I think that's reasonable, but, I might be different. You might be different. There's not just one asset allocation for retirees. If I were nitpicking, you could say, well, is 2 years, you're leaving a lot of money out of stocks and bonds. At the moment, that doesn't seem too bad because money markets and T-bills are paying a pretty good yield. Over time, might that cost you a little bit? It might. In fact, Harold Avinsky eventually concluded that his clients only needed 1 year of cash. And so he actually reduced the 2 years to 1 year. But again, I don't think, in my view, I don't think 2 years is excessive. I think this is excellent. I don't have a setup like this at the moment. But my setup will be very similar to this, frankly. Again, I don't know that I'll have 2 years worth of cash, but I think this is an excellent setup, and I think it's a great way to go. So I like it. That's my take on it. All right. Question 2, how to get started investing later in life. And there's actually 2 questions here. This person is an independent consultant stylist. So I'm taking that to mean that Faye is sort of self-employed, okay? She's 61 and wants to start investing. That's her first question. Second question is, she'd also like to invest in physical gold. At least that's how I understand it. Gold to keep in my possession. So there's sort of 2 questions there, and I'll cover them both. So let's start with the investing. Here's how I would think about it, frankly, at any age. There's a couple things. First, I'd want to know, when do you start planning to spend the money? She's 61, but since she's wanting to save, I'm assuming she plans to work for some period of time. Let's just assume she's going to work for 10 years. Going to retire in her early 70s. That's her plan. And so you have a couple of questions. One is, what type of account are you going to invest in? So you think retirement account versus a taxable account. And if you're going to invest in a retirement account, is it going to be traditional or Roth, right? That's sort of the first group of questions we have to answer. And then once we answer that question, we have to decide, okay, what are we going to actually invest in? What's our investments going to be? Stocks and bonds and that sort of thing. And I would keep this very simple. So she's, again, I assume self-employed, which gives her some options in terms of retirement accounts, because she can, of course, assuming she has the earned income, open up an IRA and contribute to an IRA. We'll put aside Roth versus traditional for just a moment. But as someone who's self-employed, she could also open up a SEP IRA, which is an IRA for self-employed individuals. And in theory, depends on her exact circumstances, it would allow her to save a lot more for retirement than you could in just a regular IRA. She could also consider a solo 401k. Again, as the name suggests, it's for individuals that have their own business. You can include yourself and a spouse. That's it. So if you have employees, I don't think she does, but if you have employees, solo 401k wouldn't be the way to go. Now, there's no way I could tell her which approach is best for her, but you could call up, you could either work with an advisor, or if you're going to open up an account, let's say at Vanguard or Fidelity or Schwab, they can help you work through these questions. Also, particularly if you're going to do a SEP IRA or a solo 401k, for me, I would have an accountant do my taxes and help me calculate the amount I can contribute to it, because it's a little involved, and you want to make sure you get that right. So those would be the options. I know it's maybe a little more complicated, but again, you can get help to figure that out. And then Roth versus traditional really depends on the tax brackets for the most part. Both your tax brackets now, how much you're paying in taxes now versus when you retire. If you're just getting started, and unless you're making significant amounts of money where you're in the top tax brackets, a Roth often, I think, makes a good sense. But again, your specific tax situation will determine which one makes the most sense. And then in terms of investments, honestly, the starting point for me, and I'll show you an example, we'll just look at Vanguard. I would figure out what year you're going to retire. We're going to assume 10 years. She didn't say in her email. So we're in what? 2025? I think that's what year we're in. So we could look at the Vanguard 2035 fund. It's one fund. It's got stocks, international and U.S. It's got bonds. We'll look at it together. And here we go. It's the Vanguard Target Retirement 2035 fund. We can look at the portfolio composition. So you can see, actually, let's look down here. It's 68% stocks, and the rest are in bonds, a little bit in what they call short-term reserves, think cash. But this would be a simple way to invest. It's going to change its asset allocation over time to make it more and more conservative. You do have to understand, though, 68% stocks is still a lot of stocks. And so this kind of fund can lose money in the short term. It can. It can be volatile. It's not, of course, as volatile as a more aggressive portfolio that had, say, 90% stocks, which Vanguard's longer dated target date retirement funds would have. But there's still a significant amount of stock exposure, so you have to be comfortable with that. And by the way, if for Faye or anyone else says, Rob, I'm not comfortable with that, so I guess I can't use a target date retirement fund, I'd say, oh no, sure you can. Let's see here. We'll just go to the Vanguard 2030 fund. We'll pick one that's designed for someone that's going to retire a little bit sooner. Even though let's assume you still plan to work till 2035, There's no rule that says you have to invest in the 2035 fund. You could go to the 2030 fund, and its portfolio composition is 60% stocks. And you could go to the Vanguard 2025 fund if you wanted to be even a little more conservative. But the thing I like about these is it's one fund and you're done. So again, you need to figure out which fund is best for you. I can't answer that. And which account type is best for you. Again, I can't answer that. But those are the questions you have to answer. And and it's really easier than it sounds. It's probably easier than I'm making it sound. And if you're going to open this at Fidelity or Vanguard or wherever, just call them up. They'll help you work through these issues. And then, of course, on the tax side, you can get tax advice really inexpensively. You don't need to pay a lot of money to talk to a tax accountant to get this sort of simple advice. And if you have someone prepare your taxes for you now already, and she may, particularly since she's self-employed, they should be able to help you out. Now, in terms of gold, I don't invest in gold, but if I were going to invest in gold, I would consider maybe more than this, but I'm going to show you two. The first one may surprise some of you, but I'd probably consider Costco because at least compared to the spot price of gold, they are a pretty good bargain. They're right now at $36.50. I looked up the spot price. It's $36.25. You're going to be hard pressed to buy an ounce of gold for just $25 over spot. And so that's a pretty good deal. They also sell different versions. This one, this is at AppMax. This kind of bar is often sold at Costco. In fact, you can see it here. Their current list is $34.09. I think that's out of date. You'll notice they're out of stock on this one. But even for this one, actually, I didn't notice this. They're out of stock on this one too. That's the deal. Because the prices are good, they do go out of stock frequently, but they come back in stock. So they're both out of stock at the moment, but if you're a member of Costco, you can keep an eye on it. You'll be able to eventually buy some gold bars from them at a pretty good price. I mentioned AppMax. This is another one. If I were going to buy online, this is one I would consider. I've bought from them in the past silver that I've since, this was years ago, and I no longer own it. But what I would consider, whether it's gold or silver, are American Eagles. Now, American Eagles, these are collectibles, so it's not just the value of the gold itself. They're viewed as collectibles. If you get the older coins, I mean, some of these are worth, millions and millions of dollars. But, if you're going to get a current dated coin, you can see some of the prices here. They're over spot, but it's, $3,700 on a $36.25 spot. That's not bad. And let's see, this one here. That you'll notice too on the Eagles, and this will be true for bullion as well. You don't have to buy a full ounce, right? You could buy a tenth of an ounce. You see, this one's a half ounce, and so you don't have to buy a full ounce depending on how much you want to spend. But I like American Eagles. Again, I don't own any. I have in the past. I owned some silver American Eagles that again I sold, but I'd probably lean towards American Eagles, gold or silver, if I were buying today. But I mentioned the Costco bars because they're so close to spot price. Again, you just got to find them in stock. All right. Well, those are those two very different questions, but hopefully that's helpful. All right. Next question. What are the pros and cons of Coast Fire? This is from Sharad. He says, what is your opinion on Coast Fire? In your assessment, how does it hold up as a legitimate planning approach? Well, so the idea of Coast Fire is pretty simple. You save up for your retirement. Let's say you're going to retire at 60, but you conclude by the age, I'll just pick an age, by 45, you've saved enough. Not that you can retire at 45, but if you just keep the savings you have, you don't need to save anything more. It'll earn returns, of course, hopefully to do well over the next 15 years in my hypothetical. So you can sort of coast into retirement. Financial independence, retire early. I don't know if 60 is considered early or not these days, but you could pick a different age. But that's the idea. You can stop saving at some point in your journey. You'll keep working and presumably just spending all of your money and I guess enjoying life. And you'll let your retirement savings continue to compound and you'll coast into retirement at whatever age you've chosen. And hopefully the markets have done well and you can retire as you've planned. I think in theory, it's an approach that can be reasonable, But I think there's some practical things to keep in mind. The first is you don't know how the market's going to do. So you stop saving, let's just say you stop saving at 45 with a plan to retire at 55, and you've done some math that says if your investments grow at 8%, you'll be good. Well, that's fine, but they may not grow at 8%. So you just have to be aware that reality may come back to haunt you a bit. And also, a lot of things happen in life that we don't expect. So, you may have this sense as to what your expenses are going to be, what they are now, and then life happens. And so, you just have to be prepared to not retire at 55 and have to keep working. I will say I'm not personally, for me, I don't think Coast Fire it would be a good way to go. It's certainly nothing that I ever pursued, in part because I just have to save money every paycheck. I don't like the idea of working hard, making some money, and not saving anything. That just drives me up a wall. Can't do it. I just can't do it. Sorry. So Coast Fire is not for me. I think there are a lot of variables that can change quickly, particularly if the period of time between when you stop saving and when you want to retire is lengthy, which I think in most cases it is. I mean, if you're going to stop saving 6 months before you retire, I'm not sure anyone would call that Coast Fire. But if you think of a 10-year period or longer, a lot can happen. And so for me, I'm not sure Coast Fire would be the approach I would ever take, but I can't say that it's unreasonable. You just have to be prepared to deal with a lot of uncertainties. Now, one thing I will just show you, you can model all of this in software. I often go to Boldin. I thought today I'd go to Projection Lab. Projection Lab, here it is. Now, this demo account is set up for someone who's already retired. But I want to show you how you could easily set this up to Coast Fire. So you can imagine you're making money, you're saving it. We have cash flow priorities that you can set. So I could add them to whatever, and you can prioritize them. So you're saving any extra cash into a taxable investment account, or I could create one to save it into a retirement account. But let's imagine that 10 years from now, you're going to stop saving. You're going to start Coast Fire, right? And what are you going to do with that extra money? Well, you're going to spend it on whatever. You're going to increase your lifestyle. You can go here to expenses. We can create a new one. We'll customize it. And I'll just call it, I don't know, we'll call it Coast Fire expenses. And whatever the amount is, I'll just say let's say you're saving $30,000 a year, so now you're going to spend it. I'm just making a number up, of course. But you can then set a range. You can say, no, it's not going to start now. This expense is going to start, in 2035. Where's 2035? Here we go. And it could go to your end of plan. It could go to when you're going to retire. Whenever you want it. And so you could set it up that way and effectively eliminate your savings and translate it into spending. You could add this. And the nice thing about Projection Lab is, well, many things, but you can look at the cash flow by year. Now, this one, again, doesn't show a Coast Fire situation. You can see it's even got RMDs this particular year, but it shows you your cash flow by year. So you could set that expense up for 10 years from now, jump to that spot, and then see how your cash is flowing and your living expenses. In fact, we should see that extra living expense come in. Oh, we called it, what did we call it? Coast Fire. Here it is. You can see it right here. So when I get out there, if I come back, it's gone, because remember, we set it to start 10 years from now, and that would be here. Yep. And it pops up right here. So again, I would need to change more about this plan to take it out of the current retirement status it's in. But you get the idea. Very easy to do. You could do it in Boldin too, but very easy to do in Projection Lab. And then you get these visuals in Projection Lab that are excellent. And so there, you could easily model it. But again, you're using a lot of assumptions, and those, reality. If you want to make reality laugh, just tell it your assumptions, right? And so things can change. You just got to be willing to go with the punches. If you want to try out Projection Lab, I can give you a 10% discount code, but you have to subscribe to my newsletter. That's actually a requirement from the folks at Projection Lab. You're going to get an email with the code, and then you could unsubscribe immediately if you wanted to. I mean, I don't know what crazy person would want to actually do that, but you could. All right. Where are we? Are MYGAs, I guess that's how you say it, multi-year guaranteed annuities, a reasonable alternative to bonds. This comes from Kevin. he has a bucket strategy. I like what he says. I know you're not a fan of the bucket strategy. This is sort of two questions this week with bucket strategy. Bucket one is cash management account, turning around 4%. Keep in mind with the cash management account, it's just a brokerage account with some check writing and ATM features. You can actually invest in whatever you want. You could invest in stocks, but he says he's earning 4%, so I'm assuming that's in a money market fund. Bucket three, yes, we've skipped bucket two for a moment, is in equities. And notice what he's got, 65% in equities, 30% in these annuities, these multi-year guaranteed annuities, and then 5% in cash. That's his bucket three. Notice that the allocation is by percentages, not by years of expenses. All right, I'm asking about bucket two. His bucket two is just 100% multi-year guaranteed annuities. He says he's 2 years into a 7-year term. He's earning 6.5% annually. He could access up to 10% annually. He says with a penalty. I'm guessing he meant without a penalty. We'll come back to that. No bonds, no ETFs, and he wants to kind of know, does this make sense? So a couple of things to think about MYGAs. First of all, they're very much like certificates of deposit, where you notice in his case, it's a 7-year term. You have a certain term, you get this guaranteed interest rate. The big difference are the penalties. The penalties for a multi-year guaranteed annuity can be huge. And so you have to keep that in mind. The penalties do go down over time as you get closer and closer to maturity. And you can, in some of them, take out a small amount, without penalty. And that's why I'm thinking that 10%, he meant to say without penalty, but you want to check the terms of each contract. And that's the other thing. These are not with banks. CDs, you get an FDIC insured bank. These are with insurance companies. And so you're going to have some protections depending on what state you live in. You want to understand what those are. I personally would not put more in than I have protection for from whatever state you're in. Just like you wouldn't want to exceed FDIC insurance limits at a bank. Same thing here. So you just have to keep in mind that you've got that penalty. You want to keep in mind the insurance limits where you live and not going over them. The other thing I will mention is they're not quite as flexible, in my view, as bond ETFs and bond mutual funds. Keep in mind that with the bond funds, you've got a lot of options, right? I could put some in like a BND, which is just a total U.S. bond market. I could put some in a TIPS fund that's going to give me some inflation protection. If I wanted to, if it were a taxable account, I could put some in municipal bonds, municipal bond fund. I don't often do this, but you could look at high yield bonds or even international bonds. So you have a lot more flexibility with bond funds, which is why I prefer them. But I think if you're comfortable with all of the limitations of a multi-year guaranteed annuity, you understand the penalties. If you take out money early, I think they're a reasonable option. You're subject to the risk that inflation gets sort of out of hand, right? But, inflation is a risk for regular bonds as well. So in that sense, if we go back to Kevin's setup, I can't say this is at all unreasonable. I think multi-year guaranteed annuities can be a reasonable approach. I think it's one of many reasonable approaches, not one that I've personally taken, but so what, right? I can't argue with it as long as you understand the risks, the limitations, and there you go. All right. How do I move my IRA away from a financial advisor? This came from Chris. A friend recently recommended your YouTube channel. I learned so much, so thanks for all you do. I've been retired for 4 years and have been working with a financial advisor who I think has done well by me. I'm averaging 8% return, but I think it's time to simplify my IRA. So this is in an IRA, currently 7 individual stocks and 14 mutual funds. You just got to love financial advisors. I just don't get it. I don't understand. Okay. Yeah, I know. And manage things myself. I've really appreciated your recent videos on assessing how to leave a financial advisor. I had one on firing your advisor. But she's a bit overwhelmed by a couple of questions, and let me see if I can show them to you. Here we go. Here are the questions. When is the best time to move my account? And here, her primary concern seems to be with dividends and end-of-year factors. That's question one. Question two, I believe I can open up an IRA at Fidelity, Vanguard, wherever, and transfer everything. But does it make more sense to cash out and then reinvest into fewer funds, or to transfer the portfolio as currently composed and then rebalance it over time? So those are great practical questions. So my take, first of all, I don't know what the end of year factors would be. You're in an IRA. You're going to keep the money in an IRA, putting aside where you have it for the moment, whether it's Fidelity, Vanguard, or somewhere else. It's going to stay in an IRA. So there are no taxes for buying and selling your investments inside that IRA. So I don't really know what the end of year factors would be. I can't think of any. I could certainly be missing something. Wouldn't be the first time, but I can't think of any. I personally wouldn't be too concerned with dividends. Keep in mind that what happens, there's a lot of talk about buying or selling something right before dividends get paid. But remember that when a stock or ETF or a mutual fund pays a dividend, let's focus on a stock, because all ETFs and mutual funds are a basket of stocks, right? So when a stock, say Apple, pays a dividend, what the exchange does, they paid a 10-cent dividend, whatever it might be, so we're going to lower the price of Apple by 10 cents. Why? Well, because they've just taken 10 cents of cash times, millions of investors, taken it out of their checking account, Apple's checking account, right? That's what Apple has done, and paid it to their investors. So in other words, they've given away what is typically, millions, billions of cash. And so the value of the company's gone down. And so they lower the price of the stock by the amount of the dividend. And so, do you get the dividend or not? I mean, if it really concerns you, just do the transfer when they're, within a week or two where there are no dividends being paid. The mutual funds are typically going to pay dividends, stock mutual funds, on the calendar quarters, right? And many stocks do too. You do have 7 stocks, 14 funds, so you may need to look at it a bit. But if it's concerning to you, you should be able to find a period of a couple of weeks, maybe even a whole month, where no dividends are getting paid. So if you should be able to work around that if you want to. Now, the other question, though, and I think maybe the most important one, is, do we sell the funds now? Do we transfer them? So a couple of things to keep in mind. You may not need to transfer your account. The first question I would ask is, where is your advisor holding your assets? They may be custodied at Fidelity or Schwab or Vanguard. They may already be at a broker that you'd like to stick with. You may not need to do anything. You might just need to remove your advisor from the ability to trade on your behalf. And of course, I talked about that in the previous videos that you alluded to. But even if you do want to move, then here's what I would start thinking about. What investments do you want to move into? Because that could affect where you open your new account. If you want to invest in exchange-traded funds, I don't really think it matters, at least not for that reason. You can buy ETFs pretty much at any broker. If you want to invest in mutual funds, however, it's probably best, although it's not required, but to open up the account at the firm whose mutual funds you want to own. So if you say, I want to own Vanguard funds, I'd probably open it up at Vanguard. Why? Because if you go to Fidelity or Schwab or anywhere else, and you try to buy a Vanguard mutual fund, they're likely going to charge you a fee each time you do so. I'd call it about $75, but it's going to vary from broker to broker. And why pay that fee? If you want Vanguard mutual funds, just open it up at Vanguard. Of course, I would say at the same time, I think ETFs are quite reasonable. It's kind of where the industry is headed. If not, they've already gone that way. So you can get the same Vanguard mutual funds in the form of an ETF, and those you can buy anywhere, or at least most places, without a fee. But you want to think through, what am I going to move my money into? And is it going to be mutual funds or ETFs that could affect where you open your account? The other thing to keep in mind is, depending on your investments, you may not be able to transfer them in kind to the broker that you want to choose, particularly mutual funds. I wouldn't expect you to have any issues transferring publicly traded stocks in kind. Now, if this were a taxable account, this would be really, really important. You wouldn't want to sell these investments, trigger taxes, and then move them. You would absolutely want to move them in kind. But in this case, it's an IRA. It's probably not as important. I think some people think, let's do it in kind because I don't want to be out of the market even for a couple of days. And if that's you, then try to transfer them in kind. Again, whether you can transfer the mutual funds in kind will depend what the mutual funds are and whether the broker that you're transferring the account to will allow you to transfer those mutual funds in kind. They may or may not. Frankly, if I were doing it, here's what I would do. I would liquidate everything to cash, move the cash over to the broker that I would chose, whether it's Schwab or Fidelity or Vanguard, and then I'd buy the ETFs that I wanted all at one time to create whatever portfolio I decided was best for me. That's probably how I would do it. I think it's just as reasonable to say, well, I'll sell everything in the current account, buy the ETFs in the current account, so I can do that right away. It will then take a couple of days to settle everything and then move those in kind to the broker you want. I suppose that would be reasonable as well. If all of this is kind of making your head spin, what you can also do is call the broker you've chosen to open your account with. So if you're going to go to Vanguard, let's say, call up Vanguard. They have a whole department that will help you figure this out and help you transfer this IRA and the assets in it to your new home at Vanguard. Again, Schwab will help you. If Schwab is your choice, Fidelity will help you. If Fidelity is your choice, they have a vested interest in getting your money, so they're more than welcome to help. And depending on how much you have, they may give you a bonus for moving your account over to them. So that's worth asking about as well. Well, there you go. Is that all 5 questions? Did we get them all? I think we did. All right. Whew. Well, listen, if you have any questions, leave them below the video. I'll be happy to help you out any way I can. I'll leave links to the different things I've shown you, including a link I didn't show you, but that has current rates for multi-year guaranteed annuities, if that's of interest to you. And until next time, remember, the best thing money can buy is financial freedom.